Hey guys, it's Ms. Benson. Last time we met, we spoke about monetary policy and how a country's central bank or the Federal Reserve could influence the M1 money supply to try to deal with a recessionary situation or an inflationary situation. In other words, by increasing the amount of M1 money in circulation and speeding up the circular flow model, the Federal Reserve could help to put the gas on our economy and try to get us out of a recession and close a recessionary gap. By decreasing the amount of M1 money in circulation, the Federal Reserve could basically put the brakes on the economy and they could slow down that circular flow model, so that would help to quell or close an inflationary gap. Now remember the step-by-step process that we talked about to describe how this happens. When the Federal Reserve increases the M1 money supply, that's going to shift the vertical money supply curve on the money market graph to the right. When that curve shifts to the right, that's going to result in a lower equilibrium nominal interest rate. Now remember, when nominal interest rates are lower, people are more interested in going to the bank and getting loans because the price of money is cheap. And so businesses will go get loans to use for investment in physical capital in their businesses. And also consumers might go and get loans for renovations for their houses or mortgages. When there's an increase in I or an increase in C, we know that those are components of aggregate demand. And so that leads to an increase in aggregate demand. On the aggregate demand, aggregate supply graph, when aggregate demand shifts to the right, that's going to lead to an overall increase in the price level of the economy and an increase in real GDP. It will also lead to a decrease in unemployment because remember that real GDP and unemployment are inversely related. When the Federal Reserve decreases the money supply, that's going to shift the vertical money supply curve on the money market graph to the left. That's going to result in a higher nominal interest rate. Whenever nominal interest rates are higher, people are less likely to go get loans from the bank because the price of money is a lot more expensive. Nobody wants to pay back a loan with a high interest rate. So when people don't go to the bank and get loans, that means that they're not spending money on businesses, so I goes down. They're also not spending money renovating their houses because they never got that loan, so C could go down. Since I and C are components of aggregate demand will shift to the left, and that would close an inflationary gap. When aggregate demand shifts to the left on the aggregate demand, aggregate supply model, that means that the overall price level in the economy will fall, real GDP will also decrease, and unemployment would increase. But how does the Federal Reserve or a country's central bank shift this vertical money supply curve? Well, remember that there are basically three main tools in the monetary policy toolbox. There's going to be the reserve requirement, the discount rate, and their favorite, open market operations. The reserve requirement refers to a percentage of people's checking deposits that the banks have to keep on hand in case people want to come to the bank and withdraw their money. Having this amount of money on hand tries to help prevent a bank run. When the Federal Reserve increases the reserve requirement, that means that banks have to hold on to more money so they can't lend out as much. And if they can't lend out as much, that means that they're not getting paid back as much interest. When the Federal Reserve decreases the reserve requirement, that means that banks don't have to hold on to as much, so they can lend that out to businesses and customers in the economy. Those people can go and spend that money. That would increase the M1 money supply and try to get out of a recession. Also, since more people are borrowing money, more people have to pay back the bank, which means there's more profit and more interest coming towards the bank. Remember that when we're talking about the reserve requirement and the impact that it can have on the money supply, we have to think about also how whenever somebody gets a loan and they spend that money, that's going to go to somebody's income and they're going to put some money in their bank and that bank's going to loan it out. So we have to think about that amplifying effect or that multiplying effect. We have the money multiplier. Now the money multiplier tells us the total impact on the M1 money supply that can be a result whenever the Federal Reserve changes the reserve requirement or maybe when they buy and sell bonds through open market operations. Instead of 1 over MPS like we did before, we are going to do 1 over the reserve requirement. That's going to give us the money multiplier. Now if somebody deposits $100 in a checking account, remember that whole $100 is not going to be multiplied by the multiplier because when the person took the money out of their pocket and put it in their checking account, that did not change the M1 money supply. It was M1 when it was in the people's pocket and it's M1 when it's in their checking account. So nothing really changed. we actually don't multiply any amount until the first loan is made. So if the reserve requirement is 10% and somebody puts $100 in their checking account, then the bank has to hold on to $10 of that, but they can loan out the other 90. So it's not 100 times the money multiplier of 10. It would be 90 times the money multiplier of 10. But the Federal Reserve doesn't always change the reserve requirement often. So their second tool in the toolbox that they can use to change the M1 money supply is going to be altering the discount rate. Sometimes even banks need to borrow money. And banks can either borrow money from other banks or they can borrow money from the Federal Reserve. The Federal Reserve is kind of like their parent. So if they go to the Federal Reserve and they need to borrow some money, the Federal Reserve does still have to charge them interest just to keep up with inflation. So just the interest rate that banks pay on their loans to the Federal Reserve just has a special name. It's called the discount rate. Now, if the discount rate is lower, then banks are more likely to get loans from the Federal Reserve. And if banks get loans from the Federal Reserve, they have more money that they can lend out to other people. That's going to inevitably put more money in the circulation. If the Federal Reserve increases their discount rate, then banks aren't really going to want to get a loan from the Federal Reserve because that loan is going to come with that really expensive interest rate. So banks are less likely to borrow money from the Federal Reserve, which means they have less money to loan out to consumers and businesses. When banks borrow money from the Federal Reserve, that's called the discount rate. When banks borrow money from neighboring banks, kind of like their siblings, then that has a special name called the federal funds rate. So the federal funds rate is going to be the interest rate that banks charge to other banks whenever they lend them some money. This is usually about 1% less than the discount rate. But this is also not the Federal Reserve's favorite tool in the toolbox. Honestly, guys, the favorite tool in the Federal Reserve's toolbox by far is going to be OMO, or open market operations. Open market operations is just a fancy term to talk about the buying and selling of government bonds, or U.S. Treasury bonds, or securities. They can go by any of those names. So just be familiar with them. Now, like I had shown y'all with the demonstration in class, remember that some of y'all had gotten out dollar bills and I was going to sell you some bonds. So I came around that class one day and I took up y'all's money and I gave you basically blank index cards. There's nothing you could do with these blank index cards. It was simply a promise by me to pay you back the money that I took from you. Now, when I sold bonds to you, when I sold bonds to the class, I literally came around and took money out of our classroom circulations. I took money out of your hands and I gave you this piece of paper that you couldn't use to buy anything. So when I sold bonds to the class, I was literally decreasing the amount of money in circulation. Selling bonds makes the money supply smaller. Sell small. Later after that, I decided that I needed to put more money in circulation. I needed to increase the M1 money supply. So I bought your bonds back. In the second part of the demonstration, I took up the blank index cards and I put money back in your hands. So by buying those bonds, I was literally putting money back into our classroom's M1 circulation. So buying bonds makes the money supply bigger. Buy big. So the money multiplier can also help us to figure out what's the impact on the M1 money supply when the Federal Reserve buys and sells bonds. When the Federal Reserve buys bonds, whenever I went around and picked up y'all's index cards and put money back in your hands, that wasn't M1 money until I put it in your hands. It was not in circulation until I actually put it in your hands. So we will count the full amount that the Federal Reserve spends on bonds. So if I put $20 back into our classroom's M1 money supply, that entire $20 is going to get multiplied by the money multiplier. So let's do a little bit of practice with the money multiplier. If the reserve requirement is 50% for banks, and suppose the Federal Reserve sells $10 million worth of bonds, let's figure out what the impact of that's going to be on the money supply. Now remember, the Federal Reserve, first off, is selling bonds. When the Federal Reserve sells bonds, that's making the money supply smaller. Now, since the reserve requirement is 50% or 0.5, then we can use that to find our money multiplier. Money multiplier is going to be 1 over the reserve ratio. So that's going to be 1 over 0.5, which is 1 over 1/2. And so our money multiplier is going to be 2. Since the Federal Reserve is literally taking money out of the M1 money supply, we're going to take that full $10 million of bonds that they're selling, that they're pulling out of circulation, we're going to multiply that by 2, our money multiplier. So if the Federal Reserve sells $10 million worth of bonds and our money multiplier is 2, that means that their action has decreased the M1 money supply by $20 million. Well, let's try another example. Suppose the reserve requirement is only 10%, like it normally is, and the Federal Reserve decides to buy $10 million worth of bonds. Now, since our reserve requirement is 10%, to find our money multiplier, we're going to do 1 over the reserve ratio. That's going to be 1 over 0.1 or 1 over 1/10. So our money multiplier is going to be 10. Now, when the Federal Reserve buys $10 million worth of bonds, that means that we're going to take that $10 million, multiply it by our multiplier, which is 10, and that's going to be an increase of $100 million in the M1 money supply. Finally, one last quick example with the money multiplier. Suppose we're not talking about the actions of the Fed. Suppose a person just walks into their bank and they decide to deposit $2,000 in their bank, in their checking account. If the reserve requirement is 20%, then that means that our money multiplier is going to be 1 over the reserve ratio or the reserve requirement, which is 1 over 0.2. 1 over 0.2 is going to be 1 over 1/5, and so our money multiplier is going to be 5. Now, we're not going to do the whole $2,000 that the person deposited times the money multiplier of 5 to get the impact on the money supply, because the bank can't lend out the entire $2,000. The bank has to keep 20% of that $2,000. So the bank can really only lend out $1,600. How do we know the total impact that person's $2,000 deposit is going to be? Well, we're not going to do 2,000 times our multiplier of 5. We're going to do 1,600 times our multiplier of 5, because only 1,600 is the amount that the bank was able to loan out. So that's the amount of money that's actually going out there to be multiplied. So when we do 1,600 times 5, 16 times 5 is 80. So 1,600 times 5 is going to be 8,000. So that person's deposit of $2,000 in their checking account, after their bank holds on to a percentage of it, loans out some money, that next person's bank holds on to a percentage and loans out that money, it's going to lead to an overall increase in $8,000 in the M1 money supply. So once you get a little bit of practice with this, you're going to realize it's just basically very similar to what we were doing with the spending multiplier when we talked about fiscal policy in Unit 3. Alrighty guys, I'll see you later. Bye.